Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Grant, thanks for taking some time to join me in the studio.
No, thanks for having me.
Today we're going to talk about your, style of leadership, your ability to lead corporate teams, the rituals and things that you incorporate to your daily routine. And something that in hearing different interviews with you through time, the focus on insurance bonds is something that is very unique and something that you talk about very well. So we'll spend a lot of time on that because our community are really interested in this, particularly with changes to superannuation laws and these types of things. Before we get into that sort of thing, I would like to know how you came to be in the position of CEO of Generation Life /GDG, which is listed on the ASX.
Yeah, I guess that journey, like any journey has its ups and downs. People kind of see you in a position whether you're winning Olympics or you're being CEO of a listed company and they kind of just see you there. But, for me, I was always very, very ambitious in business, probably even more so than sport, which I know a lot of people find hard to believe because that's where my profile really comes from. But I always loved business. I always loved financial markets. I've been trading shares since I was a teenager, have always enjoyed investing. As soon as I was going to finish swimming, I already had my job lined up in finance, which was going to be at Westpac and Bankers Trust. 5 years out from that, I had a conversation with two major CEOs of large banks here just to work out what should I be doing now to get myself in a great position to transition well. So I've always been a bit of a planner. And as I moved through the different positions, I think the one thing that did come naturally for me was the leadership style more than anything else. I was captain of the Australian swim team, the Olympic team. And for me, I always cared about other people's performance. And I think because I was genuine about that, that often came back into my own performance in terms of support from other team members. And I was always looking at ways to not only improve my own performance, but the people around me. And I was always heavily invested in that. And that just didn't change in business. So for me, once I got into a management position, it gave me the opportunity to work with people. It also gave me the opportunity to incentivize, drive, and inspire people to be better than what they think they can be. And I never sort of carry that lightly. So for me, those basic under sort of pinning values or drivers of performance is something that I've been able to really get from sport over many, many years, probably 2.5 decades of sport. Ever since I was 4, I first started swimming and doing other sports as well, and really take some of those fundamental principles into business and drive that. And eventually that's found me into a position where I love to be accountable, and you're no more accountable when you're the CEO. Everything good and bad rests on your shoulders within that business, and I like it that way.
Yeah, it's something that I've in researching your history and the way you've gone about things. It's very much about accountability. When I spoke to my wife about catching up with you today, she was just something that resonated with her was the amount of attention to detail, the continuous relentless focus, and how you have to get up every day, swim early in the morning, test yourself, continuous improvement, and then how that plays on in other respects of your life. But there was one follow-up that I wanted to insert here was before you became CEO, that kind of fateful meeting that you had with the two fellows that were involved in the financial services industry, if I'm not mistaken, so that was a particular meeting that ultimately led to where you are today in some respects, because Rob, who's the chairman, he, if I'm not mistaken, said to you something along the lines of, you do this sales role, and if you're good at it, then we'll see what happens. Do I have that correct?
Yeah, well, in part. So the meeting that I did have, the lunch that I had with the two CEOs was Rob Coombs, who's now my chairman. The other person there was Tim Bishop, who is the CEO of Macquarie Bank in the US. So I had lunch with them, which I was very fortunate to be able to have that sort of exposure at that level just because of my sporting career. Rob, when we came into this business, so I ran a lot of his growth assets at Westpac eventually. So that was kind of the first half of my career. And then once we joined this company, he sat me down. He knew I was really strong on the sales side, and I'd ran other areas in distribution and marketing and people leadership at Westpac and run a very, very big P&L, even bigger than the P&L that I've got today at that bank, which is easy because you're talking telephone numbers and those sorts of places. But basically he said, look, if you're able to get a decent sales uplift here and get the team humming, then when I step back from executive chairman to non-executive chairman, I'll put you in as CEO. So there was a big carrot there for me. It's quite funny. I love the thought of that opportunity, but it's not what drove me each day. It was actually the deep sense of purpose and getting the result in sales. That was actually where my focus was, which is probably what it should be like. And as an athlete, you always learn it's all about process. Yes, the goal's there. Yes, we all want to win. But at the end of the day, you've got to be able to execute the next step. And my focus is always on the next step. So I was focusing on what sales looks like today, the amount of activity that we've got going, the structure that we've got in place, how we're actually selling, positioning our products. I found a lot of the salespeople were trying to do steps, 1 to 7 in the first meeting instead of just doing steps 1 and 2, which is really all that the advisor or the potential customer could digest. So we really made that a real science within the group. We also made sure that the art of sales and building relationships was also critical. And then at the end of that year, we had our biggest, sort of sales year ever in a 15-year history of the business, and we were up 72% from the previous year. So that was good enough to get the job then.
Well done. It reminds me of the book by Seth Godin, Permission Marketing, which is one step at a time. You don't go to the bar and ask the lady to marry you on the first in the opening sentence, right?
It's exactly right. It's a great analogy. And of course, I want to be married. I'd like to be married because I feel like I'm more of a family man. But if you haven't got a girlfriend, you've got to start somewhere, and probably just saying hello to someone is the first good step.
Yeah, that's great. So coming back to that transition from professional sport into finance, which you were already doing because of these things that you had in motion, and you were, as you mentioned, you were trading stocks, which we'll come back to in a minute, I'm sure. But you said something in a podcast. I think it was with Howie, the Howie Games podcast. I think it was. You said something that your dad would say, which is retire to something, not from something.
Yeah.
Can you explain what you meant by that?
So, well, as an athlete, it doesn't matter how successful you are financially, how well you do for yourself. The fact that you're retiring around 30 years of age, you should be retiring to something else, because life is not about money. Life is about purpose. How many people retire, then, within a few years, something bad happens in their life, or they're just not as happy as they once were, or people retire too young and they probably needed a break, not to retire and sort of be in the exit lounge for the next, 40 or 50 years. Particularly as an athlete, you've got to find yourself in that situation. So, it was always a bit of a mantra in the family that, study was important, having a career outside of sport or beyond sport was important. And for me, it just came naturally. I made that statement that I actually enjoy business probably more than I enjoyed sport. I really enjoy business. I love learning all the time. Once you think you're on top of your game, there's always something to give you a quick lesson. And there's always new opportunities. There's always new challenges that present themselves. And I really enjoy immersing in all of that and seeing what we're doing at the moment. So for me, that transition was easy in the sense that I knew I wanted to do other things. Now, the difficult part about that transition is you go from being, I guess what you could arguably say in a sense is like a global CEO in something. Like I'd been undefeated for 11 years in my pet event. I'd won every major championship there was to win and broken, 15 or 16 world records or something. And so I was right at the top of my game. And then I went into Collins Street on a Monday morning and I wasn't the best at the table, I soon realized. And, you've got to eat a lot of humble pie. You've got to start learning off other people. You've got to realize that, you don't have any skills in this field that are going to offer too much value right now. Probably the leadership side and driving performance side, I certainly was able to add value there very quickly. But understanding the products, the services, the customer value proposition, where the opportunities sat within the group that would align to my type of personality and execute really well in the marketplace, all of that stuff I had no understanding of. But as soon as I realized that, the sooner I was able to actually do something about it. So I went out there, I did my MBA and I got first class honors there because I worked really hard with all of that. I was very determined, like my sporting career, to have an impact on what I was going to do next. And those words that were shared by my father and just the way it worked within my family, full stop, it was, sport was big. My brother was a world champion in sport as well. So it was big in our family, but we knew it wasn't the only thing. And that'll certainly be the same for my kids if they ever show any sort of sporting prowess or want to pursue something in that respect.
Yeah. One of the things that seems to be quite apparent is this idea that you're setting goals for yourself and for your team, no doubt as well. I'm obsessed, and I ask most people that come in like about rituals or routines that they incorporate to help keep that momentum, the focus. We had a CEO on a couple of years ago who said this wonderful line, which I've always thought of every time I speak to another CEO is, ideas are cheap, good execution is very expensive. And so we can all have these ideas of like, we set a goal, whether it's a financial goal, whether it's a lifestyle goal, whether it's a business goal, but then how do you actually put things in place to achieve that? So take this in whatever context you want, whether it's sport or whether it's business or both or life, whatever.
Yeah, often enough in business, we're normally dealing with problems. Problems and opportunities are probably the two biggest things. And in sport, it's very similar. You're dealing with a problem. Are you sick? Are you ill? Is a competitor too good, too far ahead? Are you too far behind? What's your weaknesses? But the opportunities, the Olympic Games, the Com Games, World Championships, breaking that world record in business, it's being number one in your field, selling more products than your key competitors. Obviously, if you're listed like us, it's having a share price that's sort of consistent with the results in the business and the opportunity that people see and the capability of management there. So, problems and opportunities are going to be there at the forefront of you. And if they're not there, it pretty much means you're dead. It means you're not doing it anymore. So for me, I really look at, whenever there's even a big problem, I always put it into the opportunity bucket very, very quickly. And I get very focused on execution. You're 100% right. That's where it all is. So you can have a lot of grand ideas, and guess what? Some of them are going to be really good. Some of them are going to be pretty average. Know the average one's quick. And as we say, fail fast and move on and learn from it. And then, start capitalizing on the new opportunities. It was like us within our product here. A good example of that was we were trying to open up our distribution a little bit more. We were investing in the distribution side of the business because we knew that's where all the execution happens. We knew we already had a pretty good product that just needed a little bit more refinement. We thought we'd go direct to market instead of through just financial advisors. Spent a lot of money, a lot of time, realized that the 1,000 phone calls that we got through client services that then upset all the advisors that were already supporting us, and then we only made 3 or 4 sales, probably wasn't a good idea. So we canned that and we said, okay, we're really going to focus on the intermediary channel, the financial advice channel, and we're going to build everything around that. And now, if we look back when we first came into the business 6 or 7 years ago, we had 451 what we'd call active advisors. And we've got now getting close to 2,500 today. Over the same period, that whole advice industry obviously shrunk around 40%. So that's something we're very proud of. So we knew where we needed to do business. Then we needed to create a compelling proposition for them to look like rock stars to their clients, because that's the point at the end of the day. They're trying to get the best solutions for their clients because they're delivering on top of an emotive outcome. This is my objective, to send my kids to this school or retire like this or have this sort of lifestyle. They're not worried about money. They're just worried about what money provides them in terms of their own goals. So we made sure that we absolutely aligned to that with everything we built around it. So execution is absolutely where it is at. You got to know the problem that you're solving, and you've got to have the right people behind you to do it. They're all the real critical parts of leadership, and you're going to fail in some areas, but recognize it. Don't continue to throw good money after bad, so to speak. Just cut it, move on, and do that quickly. And don't get too down on yourself. We're good at beating ourselves up as humans. I'm great at it, so don't get me wrong. This is something I have to tell myself, but ultimately there's going to be successes and failures. But the sooner you can move through those, either one of those, don't stay on your successes too long either, because it will become a failure shortly after, is really important just to keep moving forward, good or bad.
Yeah, fascinating. I love that idea of like killing the idea really quickly. We had Brian Hart's former CEO of Westpac on the show not too long ago, and he said, make the hard decisions early. And on the capital allocation side, I'm remembering a conversation that I had with Steve Johnson, CEO, founder of Forager, in 2017. He's obviously looking for different companies to invest in and what have you. And he said something, get to no as quickly as possible, get to yes as slowly as you can. This idea that if it's a bad idea, recognize that immediately, move on, no harm done, find the good idea.
Yeah, correct. You've only got so much capital as a business you can invest in. If you know, and even your gut a lot of the time will tell you very early on that you're investing in the wrong area. And there are some things that you have to stick with as well, which can be really hard because there's a lot of areas telling you no, but there's a lot of yeses, and intuitively you believe something's going to work. And that's not to do something blindly. That's not what I'm saying. It's just that you could be a little bit too early for that opportunity. And if you can manage the expense side of it, if you can be smart in terms of the way you execute it, to know that opportunity is going to come forward at some point, then I think that's even a harder area as a CEO to stay high conviction on when people are questioning you too. And we all see that there's a lot of great stories, from some of the wealthiest people in the world where they've had to stick at something for a while because they've believed in an idea. So there's that element too. But I think you see pretty clearly where the areas of failure are. And sometimes the failure is not necessarily the product or the market that it's in. It's the way in which you're marketing the product. That could be the area of failure. So failure is not necessarily this big category that everything within that category means failure and we should stop it all. It's an element of in there, okay, we've got a really good product. We know there's a market for it. We know there's demand for it from, maybe retirees or people building their wealth, whatever, your sort of certain area is. However, we're clearly not positioning it well. They're not understanding it. They're not gravitating towards it. So change and pivot from that area quick, I think is really important as well.
That was illustrated through your example before as well. Where did your passion for finance and investing come from? Because I've heard you say before that you bought, and I think you mentioned earlier on, you bought stocks when you were a teenager. Not a lot of people do that, Grant. Yeah. So where did that come from?
I don't know, because my dad's a police officer, mum's a hairdresser, so dad was a detective. He was a savvy investor though, but mainly on the property side. But yeah, for me, I can honestly say when I was 5 or 6, apparently I was running around to my mum saying I wanted to be an entrepreneur. So I always had this interest in business. Anyone that I would meet along the way, that I knew was in business, ran a company or, was very successful, I would ask them so many questions. It was ridiculous because I just wanted to know how they did it. I was super curious on, and I still am today, like what makes them tick, what drives them, what are they doing in their business that's really exceptional that I'm not doing in the business that I'm running. Like I want to understand that to be able to make it better culturally, make it stronger around its performance and make it more interesting for people to want to join and stay as a part of that organization. So, for me, there's always been this success is something that I've always enjoyed. Like I love winning. Like I've just been like that. So if I'm going to go into a field, I definitely want to win. But if I'm passionate about it, I'll kill myself trying to do it. And that's me. And that's probably a weakness of mine too. Sometimes I can get very narrow-minded on my focuses, and I can sort of, push through illness and sickness and other things and not take rest where I should. That's always been a weakness of mine in sport and in business. I always overdo it. I think, doing, 4 or 5 flights in 1 week with 500 meetings is perfectly normal and sustainable. So yeah, there's always blind spots that we all have that we've got to have some awareness around and make sure that we manage those effectively. But I just love it. Like I just enjoy it. I enjoy transactions. I enjoy the opportunity to be able to take something to market to help people. I find, would I sell these products to my mum? Like it's always the mum test that I do whenever we're creating something new or building in a new feature for one of our products that's going to make a significant difference to someone. I always do those tests on things. So yeah, there's just so many elements about it that I really enjoy. And for me, just being in somewhere where you're creating value and driving something and delivering something and trying to do things that people can question you on as well. Like I always love that. Like I know a lot of people, in essence, when someone's critical of them, it can often stop them or inhibit them or hurt their confidence. So I've always used it. I've had many great athletes, even coaches say when I was coming up through the ranks that I was never even going to break 15 minutes for a 1500 meter freestyle, or someone very significant who we all know, I won't mention their name, said I would never break this world record of Kieran Perkins in the 1500. I managed to go under 15 minutes by 26 seconds and break his world record by 7 seconds. So I just used those things, and I had to use them for years because they took a very, very long time. But you got to use the people who are going to question you, and you've got to be appreciative of the support as well along the way.
In the pool, you would have been able to have a timer that says you did this, and you'd be able to get instant feedback. What do you wake up each day as CEO? What do you wake up each day and check to see progress? Like to make sure, or maybe it's not each day, maybe it's every month, every quarter. I know you put out like your CEO's letter, you get updates if you're a shareholder and people can check them out on the ASX, but what do you look at?
Everything that's measured in the business, I try and look at each day. So I'll look at how sales are tracking. I'll look at the start of the week. What are the productivity measures saying? I'll wake up. I normally try and exercise before. I normally get all the call stats coming through, like how many calls do we get, longest sort of call time wait, average call time wait. I'll often question things if it's not good enough, or if there is a spike in volumes or volumes are low. I'll sort of source the feedback around those sorts of things. So yeah, there's a lot of little things that you're looking at in the business. There's another thing that both my chairman and I really subscribe to is just what we call an operating rhythm. In sport, I would have called that preparation. What are your training schedules? What are your big rocks that you can't move? That gym session, that critical endurance session, that sprint session over here, all that sort of stuff. But in business, it's things like, okay, how often should I be catching up with my team? What should be the objectives of that catch up? What are the 2 or 3 things that we need to know about? What are the current issues, bubbling along within the business? What are the people issues? What's the feedback from the market? So you have those sorts of forums, and you have your one-on-one, of course, with your team just to see how they're tracking against their deliverables. Yesterday, for example, we did our we're in Q2, we did our, I always get the team to do what worked well, what didn't work so well over the last quarter, and what are our objectives for the next quarter. So we might have a strategic plan. We have a clear definition of success and failure within each of those areas against the strategic plan. And then obviously I own that from a corporate point of view. And I make sure there's, no more than 2 or 3 key numbers that really matter and roll up to that. So we check in how we scoring ourselves against that. Are we aligned as a team in terms of our deliverables next quarter? You're talking sales, marketing, fund operations, finance, administration, client services, product, investment. So a lot of different teams doing a lot of different things. You're all aligned right now, but tomorrow when we wake up, we're all thinking differently. So you've got to have a leader in there that makes sure that get that alignment amongst your team members. And some people can just have a tendency to move on to the next thing too quickly before they've executed one thing really well. So you've just got the job there around the operating rhythm is to keep everyone focused on the same goal, to make sure that we're all heading in the same direction, and any problems or issues which happen every single day in business and life that we're addressing as soon as we can to make sure they don't, have a big impact on what we're trying to achieve effectively. But that operating rhythm is critical, and having hard conversations is as well.
I like to think that we invest more than just money. We invest time and energy into things, Grant. You mentioned there that rhythm is really important. It reminds me of like a Gino Wickman book, if you're familiar with traction. It's something that I wanted to ask you, which is, so you've got 300 people, we were just talking off air, across the various businesses that effectively, you're responsible for and you're accountable to if something needs to be fixed. How do you structure your days? You fly all over the world, across the country for different things. You're here today. How do you sit down each week and go, okay, I've identified that the call wait time was too long, or there's a persistent issue, I want to focus on that opportunity. How do you maintain that focus amongst all of the problems, which you said before, the chaos that can come with running a business of that scale?
I don't think you need to go into a huge level of detail if you've got a good structure in place with good people and good leaders in place, and different leaders for different eras of the business too. Is it in a growth era? Is it in a maturity era? Is it a problem era where we've had a regulatory issue that we've had to fix up? So what is the style of leadership that you actually need within the team? That's always important to critique, review, and make sure that it's doing everything that it should be to be as effective as possible within that position. So you've got to trust that. So as a CEO, as I said to my kids, they ask, what do I do for a job? I just say, I talk. That's all I seem to do. But it's making sure, one, all of those leaders are held to account against those deliverables. And if there is a problem in a certain area of the business, that's when you get into the weeds as a leader. I really want to understand it. I want to undo it. I want to understand the thematic around this consistency of, say, this customer complaint that we're receiving over here. What do we need to do to address it, to fix it? How are we going to prioritize that in the projects list? Is it human error? Is it something we need to automate from a straight through processing point of view? Is there something fundamentally wrong with this part of the product? So what have we actually got to fix? Who's going to own that? How are we going to check in against the milestones that need to get from where we are today to where we think it's going to be absolutely sorted? So you've got to make sure that you spend your energy wisely. How often are you getting out there and seeing customers? How often are you sitting down beside a team member, understanding what are their processes like as part of their role each day? So all those little things that you need to be doing on a consistent basis. And then, what's important today is going to be different to tomorrow. And then, when you're in my position, not only are you looking at BAU, you're also looking at, potential mergers and acquisitions. You're also dealing with all of your stakeholders, such as your investors, which is a big one. And so you've got all these various parties. I've got multiple boards that need to be managed. So there's a lot of different conversations that you need to be having, and they've got to be consistent in terms of what you're doing as well. Telling one person one thing versus another, what our focus is. There's got to be absolute transparency and honesty within a business, and I think that's really important that all conversations are very forthright as well. I don't try and manage to people what they want to hear. I try to manage them with what they need to hear, and I think that fast tracks a lot of the processes within the business as well. So yeah, I do have that operating rhythm in place to be able to do all of that. And if there is a problem and I need to go, deep dive into one of those areas, I absolutely will. But at the end of the day, the biggest part of my job is making sure that everyone is clear on what we're trying to achieve, and that they know they're 100% accountable to that, whether it's good or bad, and they'll get rewarded, or there'll be other consequences if it's not favorable.
It's in interviewing different CEOs and different people over the years, I've come to realize that is not very common. That idea that a CEO or a leader, it doesn't have to be the CEO, it could be anyone, drops down into below the hierarchy and says, what is this core problem? I need to get my hands on this problem to see what it actually is that everyone keeps telling me about. A lot of leaders often just kind of just sweep it under and they just keep going.
You can delegate, but you can't abdicate. And if there's a problem in your business, it's on you. So you better get down and understand what needs to be done. And then once you understand what you need to be done, make sure you get the right people in place to be able to manage it. Make sure you have the right check-ins and operating rhythm built specific around that. And then if you have to put it into what we call situation management, where you're basically checking in on it every single day if it's severe. There's things like TMDs, DDOs, like the regulator can come down quite hard on these sorts of things. And I'm very clear with our team, be proactive, see what we learn from others that have made mistakes around this, because it's new legislation only from a few years ago. So let's keep updating ours to be relevant, because a stop order comes into your business, you can't sell your products anymore. So that's something that you really want to be proactive in. But that's an example of a problem that I know has happened in other business where everything stops. And as a CEO, if you're not down and very deep with that, and if you haven't got the right, business continuity plans or crisis management plans in place to manage those sorts of things, you'll find yourself in trouble for much longer than what you perhaps needed to be. Those sorts of things, we should never be in trouble. We're very planned around those sorts of things, but at the end of the day, there is some elements of business which you can't control as well, which, things like going into COVID, going into lockdowns. Like, we had the BCP set up, the business continuity plan, and then we sort of dusted off out of the drawer that, we updated each year. We got to test, all of our technology. We've got to review a lot of our processes. For a few days, we had half the team in the office, half the team working from home before working from home was mandatory, just to test to make sure that everything worked. And then all of a sudden it got bad very quickly. Markets were going down up to 6 or 7% in a single day in March 20. We manage billions of dollars of investors' money on an after-tax basis. There's things like deferred tax assets, which are intangibles inside those funds. So that's an area where I got into very, very quick with our appointed actuary to make sure that was done, so no investor was disadvantaged. I think my head of investments didn't sleep for 5 days through that period, but we did everything spot on. We had good help, and I made sure I was across all the level of detail. So they're just a few sort of examples where you do need to get into the weeds. And sometimes you got to get into the weeds just to support your people that are already in there, sort of fighting the good fight. You got to be right behind them.
One more question on this before we move on to insurance bonds, which is a very big focus of this because it's what our community really wants to know about. When you have the BAU, so business as usual meetings, do you use like a traffic light system or anything like that to push like what is important to the surface quickly? Or do you use anything like that in your rhythms?
We do. We have a dashboard, so that has a traffic light system. So that's basically on a monthly basis. If something's a little bit more serious, and we have, like I said, our weekly Monday morning check-in with all the executive team, and the objective of that meeting is to discuss anything that came out the week before that everybody should be across, issues, or anything that we need to have a deeper understanding of, that we got to collaborate as a team to be able to work on, any people issues on top of that. And then what are we executing for the week too? What are the key focuses across some of the areas? And, more often than not, if there's pressure points in the business, that's the opportunity for people to bring it out. And that's the opportunity to ask for help as well. We're in a team. So, even if it's something that you don't feel like absolutely critical, but you're struggling a little bit, that's the opportunity to say, hey, this is a pressure point in my area, or my people can't absorb this. I need to, product's got to work better with marketing on something, or vice versa. They might need product to come in and give them a little bit of a hand. So yeah, we have the traffic light system, but that's more the formalization of how things are tracking throughout the year. Really, when people are sitting there articulating, what's going on within their business as part of that normal operating rhythm, that traffic light should be spoken about before it gets to the red.
Yeah. Okay, so insurance bonds. You talk about these each and every single day.
Yep.
I'm going to ask you to set the scene however you like. I figure maybe there's analogies or examples or however you want to break this down, because I'm imagining someone has just tuned in for this moment right now, Grant,
Yep.
and they're like, what is an insurance bond?
Well, we call it investment bond. So we get away from that word insurance, so because it is an investment. The best way to articulate what an investment bond is that it's an after-tax paying structure. What's like that? Well, superannuation is. Superannuation has a maximum tax rate of 15%. We have a maximum tax rate, regardless of your financial circumstances, of 30%. We work on revenue account, not capital account. So that means we can do things like offset capital losses against income. So therefore, our effective tax rate compared to another 30 cents in the dollar structure around tax is often much more effective across pretty much all asset classes. So it's a very compelling proposition, therefore, from a tax point of view. So we're investment agnostic. We put on 68 different options on our investment menu that you can choose from, or have a mixture of all 68, if you will. And then on the other side of that, what's another great thing about the investment bond, and this is where the insurance bit is actually quite good, because it's an investment-linked life policy. You actually get the benefits of the Life Act, which means, for estate planning purposes, you have binding nominations. So for some reason, you don't like your family, or you've got kids from a different relationship or marriage, and you've got a lot of money within your estate, it's going to be contested. These are a great estate planning vehicle because not one of these have been overturned. So we see a lot of wealthy people leaving for charity, for leaving for a child that might need a little bit more money just because of, reasons for within the family, but they know the other kids are going to be upset about that. So it helps for estate equalization because it doesn't go into probate or anything like that. If you want to set it up as a non-estate asset, you can do that. Other big benefit, again, is because of tax. So it's tax-free, 100% tax-free upon death, regardless of who the beneficiary is, whether they're a dependent or a non-dependent. So yeah, a lot of attributions towards an investment bond. And the reason that we actually got into this space was because of those changes to superannuation in 2017, where they said, hey, the party's over in super now, and we're seeing more and more of that. We got a cap super. It wasn't meant to be a sort of tax haven for wealthy individuals or people to put a lot of money in there. We've sort of seen the amounts of money that have gone into the trillions of dollars that we see in that system now. And it was actually the coalition government that said the party's over. So they capped, concessional, non-concessional, total super balance cap. We saw the Labor government in more recent times, which with Division 296, with the balance above 3 million, it was proposed legislation going to be taxed on earnings and the unrealized component up to 30%. In total in that. And then you had that not being indexed, that threshold. So I think the narrative around superannuation is the party's over. If it's not this change, it's going to be some sort of other change. So people naturally need to look for alternatives. And I think a lot of advisors kind of had that set strategy with super, which was the smartest strategy, just to put all the surplus income in there, particularly when preservation age was 55, not 60 as it is now. So I think, advisors now have got to look for other alternatives. They got to be tax effective when they're looking at investments. They've obviously got to consider estate planning because we're going to go through, the biggest transition in intergenerational wealth transition that we've ever seen in not just Australia, but the world's history. So it's a great vehicle for doing that. So yeah, a lot of things to like about bonds, and to sort of package all those sort of tax benefits and estate planning benefits up. It's also creditor protection as well. It's in the Bankruptcy Act, if you want to know. Section 1162D of the Bankruptcy Act it does say insurance bonds in there are creditor protected. So yeah, creditor protected, tax, estate planning. I actually love the product. I've got them for all my kids as well. It's going to be too expensive for them to buy a home one day unless they end up being Michael Jordan or something like that in sport. But yeah, I just can't imagine, when my youngest two that are 4 and 1, what it's going to be like, particularly in Sydney or Melbourne, for them to be able to put a deposit down on a house, not to mention all of the university fees and everything else around, just living costs and having to save on top of that for what it's going to be, maybe $500,000, $600,000, $700,000 for a deposit potentially by the time that they get there, in the next 30 years. It's pretty wild. So I feel like it's actually the responsibility of a parent to be able to help with that now.
I've got so many questions to unpack from this because our audience will just love what you've just said for so many different reasons. One is I've been saying for years that super is a great vehicle, but it's not, particularly right now as we sit here in 2024, the end of 2024, with so many changes already in place and more proposed. People need to start thinking very honestly about not just what the system is now, but what it's going to be in 10, 20, 30 years.
Correct. That's the big thing, because the trouble was with these proposed changes, if you were someone who was 20 years away from preservation age, but you're tipping over that large super balance, you're paying the tax and you can't touch it. You can't move it out. So the inflexible nature of it is a big concern for a lot of people, given those shifting goalposts we've seen.
You mentioned something. Let's start with probably in the reverse order, which is the estate planning thing you mentioned before, where you could have binding nominations, which is something that people should be familiar with. If they have their super up to date, you can make binding nominations, different to non-binding for people that aren't familiar. Could I do that if I was someone that had a bond, but I only had it for like 2 or 3 years? Or does it have to get to that 10-year rule? Maybe this is a good segue into that 10-year rule.
No, you can set it up yesterday and you've got that binding nomination. So if you were to get hit by the bus tomorrow, then that $1 million that you put to the side to go to that beneficiary that's outside of your family, they send in a copy of the death certificate to us. We give the money out to them within probably 6 or 7 working days. So it's very, very quick. Doesn't go through probate, doesn't go through the will, haven't got all these issues of the family fighting and using that money, might I add, to go into litigation or some sort of mediation. So a very efficient vehicle and with absolute certainty. So yeah, I mean, a lot of people, sort of from the general public wouldn't even understand what is the difference between binding and non-binding. So, binding, we know what that word means, but in the context of passing on money, you probably don't know, is it really binding? Like even we hear a lot of people, sort of share stories even around trustee discretion when it comes to binding nominations and super. So we don't have that issue, and we've never incurred anything similar to that inside the investment bond in terms of transferring that wealth. The other aspect that we really like around it is the fact that you can transfer your funds how you want to. So if a 10-year-old's getting $1 million, probably not great. Someone else is probably going to use those funds. But you might say, look, that person's passed away, this $1 million has gone to a 10-year-old, but they've got restricted access until they're 21. And you've restricted that access on a percentage or nominated a dollar figure per year until those restrictions are gone, perhaps when they're age 30. So when you can trust them with the money a little bit. So you've got this added flexibility, and we're the administrator of that. We're the life company that actually does all of that for you as per your instructions. And then obviously it's protected by the Life Act, by the legislation as well. So yeah, that part around the estate planning and binding nominations, absolutely critical in this day and age. I mean, I sit here, I've got 4 children, but I've got 2 from my first marriage, 2 from a second marriage. So I'm going to have some level of complexity, obviously, when I sit down and I look at my estate planning and what that could look like for each of the children and my wife.
So there are 2 things that I wanted to ask you to explain, is the 10-year rule, and then there's this other number that people seem to see around the place, which is 125%. Can you explain what those 2 things are?
Yeah, sure. So like anything, like when you look at super, there's only a maximum amount you can put in or bring forward or a certain age where you can access it. Like any other legal structure that you're investing through, there's certain rules around it. So the first one, the 10-year rule, when it comes to estate planning, doesn't matter. If you set it up today, tomorrow something happens, you get all the benefits of that. So it's tax-free upon. We see a lot of people who might take money outside of super that has a taxable component that are near the end of life who use our structure because they know they were going to pay a big tax liability out to that non-dependent beneficiary that those funds were meant for. So the 10-year rule, when does that kick in? So you set up, put $1 into a bond today, you add to it over time. By the time that gets to 10 years, those funds, you can take that money out, call it $1 million or $10 million, and there is nothing to declare to the ATO. So regardless of what your marginal tax rate is. So you're paying 47 cents on the dollar, you're earning $1 million over here, then you've got $10 million in this bond. Take it out, nothing to declare to the ATO. What happens inside 10 years? Still there's a lot of tax benefits. One is, you're actually deferring tax in that scenario. So if you need to access it say at year 6, you've paid at a much lower marginal tax rate in those funds than what you would have probably in your own personal tax rate, or perhaps against some other structures that you might be using. However, if you do, say, withdraw a partial amount, ATO looks at part of that as capital, so there's obviously no tax on that. Then there's earnings on some. What you do is you pay the difference between 30% and what your marginal tax rate is. So even inside the investment bond, if your tax rate's been 10%, you still only pay the difference between 30% and your marginal tax rate, which worst case scenario is obviously a 17% difference if you're on the highest marginal tax rate. So lots of benefits inside 10 years, but when you hit that milestone of 10 years, there is zero to declare, whether it's a partial redemption or a full redemption at that particular point of time. So the way I present from a tax point of view, very tax effective in the first 10 years, highly tax effective post 10 years. So that's one aspect. That's the 10-year rule. The 125% opportunity is we call it. Like I said, with other structures, there's certain limitations of what you can and can't put in. There is no maximum amount you can have in a bond. So you can have whatever you want in there. So if you want to start with $100 million, you can start with $100 million. Where the limitation kicks in a bit is you can put in a maximum of 125% of the previous year's contribution. So if in the previous year you put in $10,000, it means that next year the maximum you can put in is $125,000, $12,500, sorry. So what that is doing is basically saying, hey, if someone started the clock ticking with $1 investment in year 1, then got to 9.9 years and decided to put $10 million in, then they're in this, tax-free sort of space and nothing to declare on that particular investment. It wouldn't be entirely fair. So they basically just limit it within the investment. Reality is, like I said, you can start with as much as you want in there, and there's no limit on how many investment bonds that you can have. We've got clients that have got 20 because they've got children and grandchildren that they're looking after, and different permutations within the family tree. So they've all got different vesting conditions and stuff like that. So there's no limitation on amount, no limitation on how many you can have. There is a limitation though, what you can put in compared to the previous year, which is 125% of that prior year.
And if I say that in your example, I had 10,000 this year and I did $12,501 next year, so I stuffed up, right? What would happen in that instance?
So what would happen, it would flag in our system. So if that was coming through as an add-on investment or a regular savings plan, we would say, hey, you're going to breach that 125% rule. What would happen if you said, no, that's fine, let it go through. I'm meaning to do that, because some people do have reasons to keep it inside the 10 years. That 10-year clock would start again from that bond. So it's not like you're penalized or something bad happens. It just means the clock starts again. And like I said, there's reasons for some people that do that. But like I said, there's flags in our system to make sure that we either contact both the financial advisor and the investor to make sure that was the intended purpose. And we've saved a lot of people from themselves along the way, might I add.
Yeah, I can imagine. Before you said something about creditor something or other. What's
creditor
that?
Protected. Yeah, it's one of the, if I ever say investment bond, I'm saying, normally tax arbitrage, normally estate planning, but a lot of people set up a trust for two reasons. One is asset protection. Two is so they can do income splitting. So particularly if someone's not working in the family who's an adult beneficiary of that trust. So it's very handy like that. An investment bond kind of covers that off as well because it is creditor protected. So Section 116(2)(d) of the Bankruptcy Act says investment bonds are creditor protected. And it's even fantastic if you fall into some degree of financial hardship, you write to the life company. So in this scenario, you write to Generation Life and you say, look, something's gone bad in my life. I'm in financial hardship. We determine whether you're in financial hardship, and then we can actually release money from that bond into your bank account. That is, again, creditor protected going into your bank account. That can't be accessed by other creditors if you're in financial hardship. And that 10-year rule goes away as well in financial hardship. So if you're only at year 4 or year 5, there is nothing in addition to declare on a tax on your tax return if you're in financial hardship, and we've deemed that be the case. So the creditor protective feature is awesome. Like it is really cool in terms of the flexible nature, I guess, of having that protection around that particular investment. We have a lot of people that might be in fields like medicine or even the legal fraternity that actually set up their bond. We've got one extremely wealthy individual I know. He adds $1 or $2 million a year into his investment bond just because he's in a field that's subject to malpractice. And he says, I just want to make sure that my kids have this asset and that's it. If they don't get the other stuff, that's fine. But I want to make sure that this, whatever happens to me in my profession, that this is absolutely protected. So yeah, it's funny. People use it for all sorts of different features, but I always say they're the three core categories. If you're usually coming in to want an investment bond, that's the rationale behind it.
I'm glad you called it an investment bond as well, because I think that frames it better than insurance bond. I think that's all my old research days. I call them insurance bonds because of the act and everything.
Oh, we changed that when we came in because it's misleading. Even the word bond is misleading, which is quite frustrating because everyone's like, oh, it's a fixed interest product. You know? And even some very senior people in finance hear that word and that's what they associate it with, which is, you know, a pretty normal mistake to make, but it's just because it's a life insurance contract. So it's a bond. So it's an insurance because it's an investment linked life policy. So you have these two words, insurance, which, you know, commonly is going to be used for some sort of exchange of contract. And then bond, it's obviously an agreement between, you know, a couple of parties. So, but it's your investment.
Yeah. So maybe so for people that don't have the nuts and bolts, I am an investor. I've got a long-term time horizon. I'm thinking about not just my family, but also myself. I don't want to just rely on super. I have, say, 10,000, 20,000, 50,000, whatever I've got here and now. And I'm thinking, what Grant's talking about sounds pretty good from a tax perspective because I'm going to earn more. I'm still in my career, whatever. What does the bond actually do? So just very simple. I put the money in, what happens?
So yeah, it's pretty straightforward. You put the money into an investment bond, you choose your investment. We've got all the big fund manager names on there, your Vanguards, your BlackRocks, your Dimensionals, your Magellans. You know, we've got a broad range, you know, the Firetrails of the world, the Hyperions. Hyperion was number one, I think, fund manager last year in terms of performance. So, you know, we've got a whole range across 68 different options. It goes in there. What happens from then on? Basically nothing. You just watch your investment. We pay all the tax for you. We tell you what your effective tax rate is. We tell you what your investment performance is. If you want to switch or you want to diversify for some reason because your circumstances change, you let us know. You go, okay, I want to go into Vanguard Balance now. I don't want to take on the growthy sort of you know, products that I was in previously. And then over time, you probably determine if you want to be able to add to that bond or start another one. So it's actually it's very, very simple from an administration perspective. It's very much set and forget unless you want to be a little bit more active with your investments in your chosen fund. But like I said, we're investment agnostic. So we create an investment menu. It's not quite the size of a platform, but it's a quasi platform in the sense that you get all these different investment options across multiple asset classes that you actually choose. Normally with your financial advisor, most of about 92% of our inflows come through compared to the direct space. And basically you go, okay, that fits my risk profile. And, you know, a lot of these investments are much for muchness across some of the different funds, whether it's a 60-40 or 70-30, whatever you're sort of looking at that aligns to that risk profile. So yeah, it's very, very straightforward. And then if you're doing it for estate planning, you do the investment and then you set up, you know, it's very simple on our application process. Is this for estate planning purposes? Do I have a beneficiary that this goes to? Do I then have vesting conditions? No, yes. And then you just determine what those are as per your wishes. So yeah, it's actually a very, very straightforward process. And like I said, I invest these for my kids and I make sure that I go through the process myself just to see if there's any kinks, and the application process is super easy.
I've got two more questions. It's probably the more discerning listener or viewer want me to ask. Fees. How do fees work with these things?
Yeah, so when we came in, there was a flat fee regardless of what your investment was. So we ended up doing a tiered structure. So, you know, the top fee, 60 basis points, and then slides down there very, very quickly. So the average investor to get all of that, what we do from a tax point of view are the estate planning features that we've built within the product, and obviously managing the product because we do all the tax paying, etc. Usually sits between 30 or 40 basis points. And for people over a certain balance, our administration fee is actually for free because we're a scale business, and you know that's how we make our money. So yeah, fees are much more compelling than what they used to be in this space. And you know, you're talking to the CEO of one of these firms, so of course I'm going to be naturally biased, but I think you get a lot. Like if you saw the amount of effort that we put into managing our investment managing the tax performance, building out the estate planning features, minimizing the tax position for all investors, and really spending the time to articulate that proposition, which tax does have a lot of complexity around it. So, we do have big teams working on that and making sure that all of our communications matter when we talk to a client. They're all moments of truth for us as a business. So yeah, you get a pretty good deal for all of that. Then, of course, even pricing of some of those investments, a lot of those discounts we'll pass on back to the investors because they would normally pay for those directly, would be a lot more expensive. So there's also something in that for them, again, because we're a much larger business negotiating with those fund managers versus an individual.
The other one is I've long looked at investment bonds and thought they're great, particularly for people on higher income. Not necessarily people that are only on higher incomes. So I think that's a misconception because I think a lot of people will scale into a higher tax brackets naturally.
This is what we try and articulate really clearly, particularly to advisors that get it, but even to direct investors, is that if you're a young person who's on $80,000 or $90,000 a year, do you think you might get to the highest marginal tax rate? Oh yeah, I'm pretty ambitious. Wage inflation, all those sorts of things. So you're going to get promotions, wage inflation. Therefore, why would you set up an investment that is going to probably yield some form of income as part of its overall return that's just going to add to your taxable income? And you're not making enough money to go set up a trust or other things where you might use those sorts of vehicles. A lot of our wealthy clients own their investment bond inside their trust. But the thing I love about the investment bond, think of it like super. It incubates your investment in that environment. So if you've put that $100,000 in there, it's getting a 7 or 8% return. That 7 or 8% return of the balance of its income is not adding to your wage. And as we know, you get to a point where half of your wage is actually going in tax. You don't want half of your investment going in tax. So if you can keep that in a lower tax environment than what you think you're going to be growing into, then it's a smart way to set up the investment and be a little bit proactive around your planning.
Definitely. My other question for you was more so around, so I've looked at them and they've always seemed great to me, particularly for those people that we just talked about. But what happens, Grant, if you do your job really well and the business keeps growing, the industry keeps going, and then whatever governing body is in place in 10 years goes, hang on a second, that Grant Hackett fella, he's got this thing and these guys over here, they're doing really well.
Yeah.
Maybe we need to change what's going on over here. You understand the legislative risk. How do you think about that?
Yeah, so we obviously spend a lot of time on looking at, the incumbent government, what their view is, what their policies are going to be. And obviously we stay very close to Canberra on that because we want to make sure that if there's going to be an impact or if there is an impact, what's the extent of it? We actually look at our product as low legislative risk, and there's a few reasons for that. One, we're actually an efficient tax collector. We have tens and tens of thousands of investors that we collect the tax for and we pay the government on a quarterly basis. The second part on that is that we're a $14-15 billion industry. Super is $3.9 trillion. We're looking at family trusts have just hit $1 trillion in total value. We look at negative gearing, the impact that has, the value of franking even inside super, which was a big part of the election in 2019. So there is all these other areas that the government could actually play with in a very small way and reap a huge amount of benefit. $14 or $15 billion, they could play with us in a significant way. And they're not going to get too much benefit out of that. So I don't really see the incentive for someone to go down that path yet. Hey, maybe when it's 4, 5, 600 billion, we could be having a different conversation and fighting them off a little bit more. So I think that's one aspect to it. The second part is I told you all those great features. The reason we have all those great features is because we're governed by both the Tax Act and the Life Act. You've actually got to change both of those to change the product. So there's a bit of legislation work for a politician. And if they're not getting extra votes out of it or generating any extra revenue to fulfill some sort of deficit or budget deficit that they might be having in future years to come, which this country is clearly going to be in, then why would you bother with it? It just doesn't make any sort of sense. So that's why we see it as low legislative risk. And when we're not hearing anything else, like I said, we stay close to Canberra. But for now, it seems to be in a pretty good spot, and it seems to be an investment that makes sense.
For what it's worth, I kind of do agree with you there. Like, I think that the amount of money in super, the 15% tax rate for really high balances, yeah, sure, with these proposed changes, even still, there's probably a lot more work there. One little tiny move of the dial over there is exponentially more impactful for them than this. Okay, so...
And it's like that Division 296, that double taxation for balances above 3 million inside superannuation. That was going to yield them, I think, over $2 billion worth additional receipts. It affected 80,000 people out of 27.5 million Australians. So, you know what I mean? You're talking a very, very small, position of the voting market out there as a politician, versus, doing something like this. You're affecting people, but you're not really getting anything out of it. You're not making billions of dollars in revenue. You're making a few extra $100,000 probably in some senses.
Yeah. So I've got a couple more questions, more just on the business overall. It's ASX listed. Since you've taken over as CEO, the business has been growing wonderfully. Obviously, you got these tailwinds, which we just spoke about, but you were saying something off air, and I was really interested to talk to you about this because I love it when I get to have these chats where it's like we can talk about business, we can talk about financial planning, investing, but we can also talk about the business that you run because it's a publicly listed business and everyone listening to this is an investor. I'm curious how you make decisions, not just yourself, your team, the board around you, make decisions because people may be familiar in the finance industry at least that, you're now in control of Lonsec, which is a massive research house here in Australia. They make money by managing people's money, helping financial advisors, providing research reports on funds, on ETFs, on all types of stuff. How do you make those types of decisions as the CEO?
You're looking at, I guess from a capital management point of view, you're looking at several different drivers, right? And you're looking at the conditions and the environment that you're in. So if you've got good cash flow businesses, what's the macro environment doing at this stage? Like you said, I run an ASX listed company. So what's the expectation on reinvestment and growth versus dividend? And how do most investors want to have their cake and eat it too. And it's funny because as a CEO, you'll speak to one investor, I'd really like to see dividends, lifted a little bit. The next investor is like, do not touch dividends. I want to see, you've got so much growth right now, keep reinvesting back into the business. So, you're always weighing up these views and you've got to have a long-term lens over all of this. So the way that I look at deploying capital and running the business is I'll look at, okay, where are the big growth opportunities right now? So, we own a large managed account business that's close to $12 billion in total that we manage. It's got significant structural tailwinds. So even if there is a economic contraction, people are changing structures into that structure. So it's not driven just by investing. It's driven by, I need to use this product category because it's better for me as an advisor and it's better from a tax point of view for my clients. And it just creates a level of efficiency overall within the business. So a lot of people are seeing that and moving to that structure, and we're definitely a market leader there. So you kind of go, that's getting capital no matter what. We want to make sure we got a great sales team. We want to make sure we got a great product solution in there. We want to make sure performance is good. The research business, obviously that's a business that's been significant in terms of the Lonsec brand. It is the Lonsec brand in many respects. It does over 2,000 individual products across both super ratings and research. Anything from, like you said, the ETFs to the fund managers through to, the various super funds and the products within those super funds as well. But the credibility is really held there. So, I'll spend more money keeping that business independent, making sure that it's got its own resources, that it can never be even perceived optically to have a conflict of interest anywhere. That's what you're trying to protect there. The brand is so significant, and it's been the number one qualitative research house for God knows how long. And so, you look at that, then you come into the insurance business and you go, okay, where are the growth pockets there? And for any of these businesses, you're kind of looking at 3 or 4 things at any point in time. Have I got enough resourcing in there to be able to execute the strategy that I'm looking at? Have I got a big growth opportunity in there? Because if the growth opportunity is big, and we've been growing anywhere from sort of 20 to 30% CAGR for over 5 years now, which has been quite an incredible rate, but you've got to invest to get that. But you've got to invest in the right areas. So some years, that's product. Okay, we've got to make the product better. The next year, it's going to be technology because we've scaled up so much, we need more efficiency within the business. The next year could be risk and compliance. All of a sudden, the government said, here's an IT standard of CPS 234 for a life company, which is unbelievably hard to be able to adhere to. Here's an operational risk review that you've got to go called CPS 230. Here's a new remuneration standard that's going to change the whole composition of your business called CPS 511. Here's a financial accountability regime, or known as FAR, that's coming to you. So these are all legislative things that are non-negotiable. So I've got to make sure I've got enough there in risk and compliance, and I'm building systems and processes in there that, shareholders probably don't see any value out, but I won't have a job if I get a lot of these things wrong or materially wrong. So, you've got these non sort of discretionary spends, I'll call them, where kind of IT walks in and risk and compliance walk in and legal. And I'm like, whatever you want as part of the strategy day. So, yeah. And you're always juggling that, right? Like different market conditions mean, you do different things. An example that I do probably differently to a lot of CEOs is when we hit an economic contraction is I heighten activity and I spend more in sales and marketing. And the reason I do that is because these market conditions never last long, but what does last for a long time is people's memories. And if you were there for them when times were difficult, if you were helping them with their clients when their clients' investments are down 15, 20, 25%, and you were able to give them, advice, articulate what the product's doing and why, this is where it's going to bounce back, or insights into the market, or just being on the phone to emotionally help with what's going on within their business, you will turn around and get more business than anybody else because you were there for them. Your BDM, was calling, was reaching out to them, seeing them face to face, not being afraid of answering the phone. And so if you have that presence in a difficult time, you'll get the benefit in a good time. So that's something that we've always done really well. And it's the right thing to do first and foremost.
I really like that answer. I would encourage anyone listening to this, whether you're a financial advisor or an individual investor, to go check out all the resources that we've included in this episode, because it could be substantial, not just for you, for your family, for the next decade or two to come. Grant, there's one question I ask everyone who comes on the show for the first time. And the question is a bit of a philosophical one. It's if you could go back in time and tell your younger self one thing, and it could be about money, finance, investing, life, anything, what would it be?
Wow, that's a good question. I would probably tell myself there is enough time. There is enough time. I often thought, even when I was transitioning from sport to business, I thought I started late because people got the jump on me. But if you're really focused, dedicated, and you've got clear goals, you always get to where you're going. And it doesn't matter whether you do it, whether you're 50 years old or you do it when you're 25 years old, there's always time. I believe in that more when I get older, and because I think sometimes my impatience has probably been a strain on me personally. So if I just knew I, still act with urgency, do everything today, don't wait, that doesn't mean be lazy, but, be a little bit more patient with yourself. I think that would be probably advice that I'd give myself. And, probably the other bit, which I do give myself this advice now, but I wish I gave it to my younger self because I've been through good times and bad times, is like, nothing good lasts forever, but guess what? Nothing bad does as well. So just sail somewhere in between mentally and you'll be okay.
Great. Well, I absolutely love that answer. So thanks for taking the time to join us today.
No worries. Thanks, Owen. Thanks for having me.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.